Hello fellow compounders, today I'm going to demonstrate how to earn $1,000 or any amount you want in annual dividends. Depending on your priorities, your focus could be on dividends or on dividend growth. I'll also give you examples of the two strategies and show you one of my portfolios where I'll earn $12,000 in annual dividends or a 25% dividend yield. A quick reminder, this video is for educational purposes only and should not be considered financial advice. I am not your financial advisor. You are responsible for your own financial decisions. Investing for dividends can make sense for many investors for several reasons. 1. Income generation. Dividend-paying stocks can provide a steady source of income, which can be especially attractive for retirees or those who are looking for a source of passive income. 2. Potential for long-term growth. Dividend-paying stocks are often established companies with a strong financial position, which can provide the potential for long-term growth. 3. Diversification. Adding dividend-paying stocks to a portfolio can provide diversification and help reduce risk, especially when combined with other types of investments such as bonds or real estate. 4. Predictable cash flows. Dividend payments are usually made on a regular basis, providing predictable cash flows that can be used to reinvest in stock or to cover living expenses. 5. Inflation hedge. Over the long term, dividends can help protect against inflation by providing steady source of income that can increase over time as the business grows. There are two different strategies that focus on stocks that pay dividends. They are dividend investing and dividend growth investing. The main difference between the two is their focus on the growth of the dividends over time. Dividend investing is a strategy where the investor invests in companies that pay dividends, with the primary focus being on generating income from dividends received. The investor may not be concerned with the growth of the dividends over time, as long as the dividends are steady and provide a reliable income stream. On the other hand, dividend growth investing is a strategy where an investor invests in the companies that consistently pay dividends and increase their dividend payments over time. I'll show you one of my portfolios as an example later in this video. The focus of this strategy is on both generating income from dividends and building long-term wealth through the growth of the dividends over time. It's important to keep in mind that dividends are not guaranteed and can fluctuate based on the company's financial performance and market conditions. Also, investing in dividend-paying stocks carries the same risk as investing in any other type of stocks. It's always a good idea to do your own research and/or consult your financial advisor. Let's see how you can generate $1,000 in annual dividends. This is relatively simple. Here are the steps. Step number 1. Start by doing some research and creating a list of companies that pay stable dividends. I prefer businesses that have paid dividends over the past 10 years. And 2, that they meet your investment criteria. I reviewed an investment criteria in a previous videos. Here's the link. And 3, estimate the stock's dividend yield. This information is easily found on sites like Yahoo Finance or Seeking Alpha. 4, calculate the amount you'll need to invest in order to obtain the dividend payout desired. This is done by dividing the amount desired by the dividend yield. The formula is amount to invest is equal to the dividend amount desired divided by the dividend yield. Here's an example. Let's say that step 1 through 3 produce the following list of stocks: Altria, AT&T, and ExxonMobil. Altria, ticker symbol MO, at a price of $46 per share, has a dividend yield of 8%. AT&T, ticker symbol T, at $19 per share, has a dividend yield of 5.8%. And ExxonMobil, ticker symbol XOM, at $115 per share, has a dividend yield of 3.2%. So let's move to step 4. We calculate the amount of Altria, AT&T, and ExxonMobil that you'll need to invest in order to make or earn your $1,000 in annual dividends. So for Altria, we would divide $1,000 into 0.08, the 8%, which gives us $12,500. That's the amount you'll need to invest in order to get $1,000 in dividends from Altria. For AT&T, we would divide $1,000 into 0.058 or 5.8%, which gives us $17,241. And for ExxonMobil, we will divide $1,000 into 0.032, which gives us $31,250. Based on the dividend yield alone, I would probably prefer to buy $12,500 worth of Altria. However, remember our investment rule, don't lose real money. I will be conservative and buy the 3 stocks instead. So if we bought all three stocks in equal proportions, the blended dividend yield will be 5.67%. This means that in order to earn $1,000 per year, I would need to invest $17,646 across the three stocks. Now, let me show you one of my dividend growth portfolios. Back in 2008, I invested around $24,000 in Altria and Chevron, $12,000 apiece. And again, in 2011, I had some extra money and I invested $24,000 in PepsiCo and Waste Management. Again, around $12,000 in each. I invested in Altria mostly for the dividend, which at the time was 8.7%, and I thought it was pretty juicy. And I invested in the other three stocks expecting dividend growth. So let's look at the results as of February 10th, 2023. Let's start with Chevron. In October 2008, I bought 200 shares of Chevron for $12,416, and in the first year I received $520 in dividends. Now, 14 years later, those shares are producing $1,208 in dividends, or a yield on cost of 9.7%. And those shares are worth currently $34,268. The dividend grew an average of 6.1% per year, outpacing inflation of around 2.5%. When we include capital gains, Chevron performed well, with an average annual total return of 11.5%. Let's move on to the next stock, Altria. In November 2008, I bought 800 shares of Altria for $11,656, and I was receiving $1,024 in dividends, an 8.8% dividend yield. Now, after 14 years, those shares are worth $37,288, and I'm receiving $3,008 in dividends, or a yield on my original cost of 25.8%. The dividend grew at an average of 7.9% per year, outpacing the inflation rate of around 2.5%. I wasn't expecting much growth from Altria, but wow, it did perform. The best part is the dividend. Not only are my shares worth more, I am receiving 3 times the initial dividend. Next, Pepsi. In September of 2011, I bought 200 shares of Pepsi for around $12,080. And in the first year, I received $412 in dividends, a 3.4% dividend yield. The yield was on the lower side, but it is a very stable business and the dividend was growing. Now, 11 years later, those shares are worth $35,000 and I'm receiving $920 in dividends, or a yield on cost of 7.6%. The dividend grew at an average of 7.3% per year, and when we include the capital gains of around 9.8% per year, Pepsi performed very well, giving me an average annual total return of 13.2%. And the best performer is Waste Management. In September of 2011, I bought 400 shares of Waste Management for $12,252. In my first year, I received $556 in dividends, which is a 4.5% dividend yield. Now, 11 years later, those shares are worth $61,000 and I'm receiving $1,120 in dividends, or a yield on my original cost of 9.1%, double of what I started with. The dividend grew an average of 6.3% per year. When we include capital gains of around 15.1% per year, the Waste Management performed very well, giving me an average annual total return of 19.7%, almost 20. Let's review the portfolio summary. I invested around $48,000 and now that's worth $167,000, a 3.5 or 3.5 times my original investment in around 13 years on average. But as a dividend investor, the best part is that I started with $2,512 in annual dividends and now I'm receiving $6,256 in annual dividends. So the dividends more than doubled and are growing at a 7.4% rate, which means that the dividends should double again in 10 years, which means that in 10 years I should be earning $12,000 in dividends from this portfolio. So there you have it. 2 approaches to dividend investing. 1, focusing just on dividends, and 2, focusing on dividend growth. I prefer focusing on dividend growth if I were investing for dividends.